In an era of economic uncertainty, one question divides investors: stocks or real estate? Which truly builds lasting wealth? Two advanced AI models step into the spotlight. One shaped by the thinking of Michael Burry, backing the volatility and logic of the stock market. The other reflecting Grant Cardone's mindset, championing the power of real estate and leverage. Each round is scored by three rival AI judges. The model with the highest total wins. This is Debatrum. Let's begin. Mr. Burry, with economic uncertainty rising, what's the smarter long-term move, stocks or real estate?
When it comes to building wealth that lasts, the answer isn't found in what's flashy or physical. It's in what works across time, through cycles, through crisis. Stocks, when chosen with discipline, represent ownership in real companies solving real problems. Over the last 100 years, the U.S. stock market has delivered consistent inflation-adjusted returns of 7 to 8% annually. That's through world wars, oil shocks, the dot-com collapse, 2008, and even COVID. The power is in the underlying productivity of businesses and the compounding of their earnings. Real estate, meanwhile, is a different animal. It's not liquid, it's local, it's capital intensive. You can't just click a button and exit your position. You can't instantly diversify across cities or sectors. And when it crashes, like in 2007 and 2008, it drags families and banks down with it. I saw that up close. People thought real estate was safe. But safety isn't about familiarity. It's about resilience and scalability. And the housing market is neither, especially when driven by debt. With stocks, you can own pieces of companies shaping the future: semiconductors, AI, biotech, energy innovation. Your upside isn't capped by rental income. You're not dealing with tenants or surprise repairs. You're not betting your future on one city block. Now, of course, markets crash, but so does real estate. The difference is that stocks recover faster, and they're not chained to interest rate swings the same way mortgages are. You reinvest your dividends, stay patient, and avoid emotional moves, and the math does the rest. I'm not saying stocks are perfect. I'm saying they've proven themselves over a century. They're flexible, global, and backed by innovation. Real estate feels safe because it's tangible, but long-term wealth isn't about how something feels, or it's about how reliably it grows.
ChatGPT scored at 9, DeepSeek 8, and Grok 8. Total, 25 points.
Let me make this simple. The wealthy don't get rich from stocks. They build empires through real estate. You know why? Because it's not just an asset, it's leverage, control, and cash flow all rolled into one. While Wall Street sells you paper dreams, real estate gives you doors, land, income, tangible, durable, scalable. When the market crashes, stocks vanish with a screen flicker. Real estate doesn't. You still have the property, the rent, the depreciation, the tax advantages. You can borrow against it, you can multiply it. That's how the wealthy think. They don't gamble on market cycles. They build structures that pay them month after month. That's what I teach. That's what I do. You think the 2008 crash killed real estate? It was a correction. The people who understood the game used that window to buy more, cheap, and then watch their wealth explode as the market recovered. Meanwhile, stockholders panicked, sold low, and waited years to recover. That's not investing. That's surviving. I don't just own buildings. I control income, I control appreciation, and I control how I use debt to grow faster. Try doing that with stocks. Try walking into a bank and saying, I own $500,000 in equities. Give me a $2 million loan. Not happening. With real estate, they'll talk because it's real. It performs. And guess what? People always need places to live. Recessions, wars, inflation. Doesn't matter. You can't outsource housing. You can't replace it with code. It's built-in demand. The right multifamily deal doesn't care what the Fed says. It just cashes checks. I'm not saying stocks can't work. I'm saying they don't build freedom fast enough. You want to wait 30 years for a 7% return? Go ahead. I'll take the asset that pays me every month, scales with inflation, and lets me own my time.
ChatGPT scored at 8, DeepSeek 9, and Grok 9. Total, 26 points.
You say real estate is tangible. I say it's rigid, vulnerable, and heavily dependent on debt. Yes, leverage can amplify gains, but it amplifies risk far more. In 2008, I watched people who thought they were safe lose everything. Why? Because they were over-leveraged, tied to adjustable rates, and had no liquidity. Real estate isn't some indestructible asset class. It's cyclical, and when it turns hard. Let's talk control. You don't control the macro environment. You don't control what the Federal Reserve does with rates. You don't control your tenants' jobs, the next pandemic, or a regional housing glut. You can't evict risk. You can't paint over it. In the Great Financial Crisis, entire neighborhoods collapsed. Property values didn't just dip, they cratered. Rent checks stopped, mortgage payments didn't. That's not control, that's exposure. The S&P 500 over the last century has outperformed residential real estate even before tax benefits. And it does so with zero maintenance, no 3 a.m. plumbing calls, no empty units. It's dynamic. It's scalable. A $1,000 investor has access to the same companies that power global growth: Amazon, Nvidia, Johnson & Johnson. Try building a diversified real estate portfolio with $1,000. You can. Real estate's illiquidity is often sold as a feature. I see it as a bug. In a downturn, you can't sell a duplex on emotion-free terms, but you can rebalance a stock portfolio with precision, even on the worst day. Markets move fast now, and static assets don't keep up. And those tax advantages, they're not guaranteed, they're complicated, and they disproportionately benefit the ultra-wealthy with teams of advisors. Most investors aren't there. They're working 9 to 5, hoping the roof doesn't leak. I'm not saying stocks are without risk. I'm saying they offer transparency, diversification, and true scale. They don't pretend to be bulletproof, that they evolve. Real estate promises control, but control is an illusion when you depend on debt, location, and tenants.
ChatGPT scored at 9, DeepSeek 9, and Grok 9. Total, 27 points.
Look, if you want to live scared, read a history book. If you want to build wealth, own something real. People talk about the 2008 crash like it's a ghost story. I saw it, I bought during it, and I've made hundreds of millions since. Why? Because I understood the fundamentals. Real estate didn't fail. Over-leveraged amateurs did. Stocks, they're digital IOUs. You click buy and hope someone smarter doesn't click sell. You don't get a vote. You don't get a say. You're not an owner, you're a passenger. With real estate, you drive the deal. You negotiate, you refinance, you increase rents, you scale. Let's talk liquidity. Liquidity is what broke people want when they panic. Wealth is built by those who commit. You think Bezos sold Amazon shares every time the market dipped? He held. Same thing with real estate, except I get paid while I wait. Cash flow doesn't care about headlines. You say tenants are a risk. I say tenants are income. Hundreds of people sending me rent every month. That's diversified. You call that a headache? I call that freedom. I don't rely on board meetings or quarterly earnings to determine my future. I own it. And here's the kicker. The U.S. government backs housing harder than stocks. FHA loans, tax incentives, depreciation, 1031 exchanges. It's built into the system. They don't subsidize stocks, they subsidize property. Why? Because housing keeps the economy running. You don't build wealth by playing defense, you build it by controlling the field. Real estate lets me use leverage, scale vertically, protect against inflation, and generate passive income. I don't need a bull market. I need doors, deals, and discipline. You want to trade paper? Go ahead. I'll be over here collecting rent, refinancing debt, and watching my net worth climb in the real world.
ChatGPT scored at 8, DeepSeek 8, and Grok 8. Total, 24 points.
You talk about control, about collecting rent, about owning the deal, but wealth isn't built on control. It's built on understanding risk and controlling for it. I predicted the 2008 crisis not because I hated real estate, but because I understood how fragile the system becomes when leverage outpaces income. You say liquidity is for broke people? That's a dangerous myth. Liquidity is what keeps you in the game when markets shift. Ask anyone who was over-leveraged in 2022 when rates skyrocketed. Could they refinance? Sell? Because liquidity disappears when you need it most. Meanwhile, equities gave you options. You could shift sectors, move to bonds, rebalance. You're not locked in by drywall and debt. You praise monthly rent checks, but miss the volatility of occupancy rates. You don't control your tenant's employment, the zoning board, or the next neighborhood oversupply. Real estate isn't immune to macroeconomic forces. It just reacts slower, and that lag costs people time and money. Let's not forget inflation. Stocks may be volatile, but they're inherently adaptive. Companies raise prices, cut costs, innovate. That growth passes through to shareholders. You think a fixed rental agreement keeps up with inflation? Not unless you renegotiate every year. And good luck doing that in a soft rental market. And the tax benefits? Yes, real estate offers them, but so do long-term capital gains, tax-deferred retirement accounts, and qualified dividends. The idea that real estate is uniquely advantaged is overstated and often only true at scale. Most people won't get there. On what you call paper, I call productive capital. When I buy a stock, I'm buying the future cash flows of innovation, not just a building. When I diversify across sectors, I'm hedging risk across global demand. That's not playing defense, that's playing smart. Real estate has a role, but as a default path to wealth, it's slow, risky, and often misunderstood. Stocks aren't on a gamble, they're ownership in human progress. And history favors the system that compounds quietly, not the one that promises loudly.
ChatGPT scored at 9, DeepSeek 8, and Grok 9. Total, 26 points.
Michael, you keep talking about liquidity and flexibility like they're some kind of golden ticket. But let me ask you, what does that liquidity get you if your portfolio isn't producing income? If your stocks are down 30% and your dividends don't cover your rent? I don't need liquidity. I need cash flow. And real estate gives me that month after month, whether the market's up, down, or sideways. You say real estate is risky. What's riskier than owning a piece of a company you've never visited, led by people you'll never meet, competing in industries you don't understand? I buy things I can touch, control, and improve. I don't need to speculate on quarterly earnings. I raise rents. I refinance at better terms. I add value to the property and to my net worth. People forget, in times of high inflation, what survives? Hard assets. Not code, not logos, buildings, land, units. The kind of stuff governments can't print more of. Inflation makes my debt cheaper, but raises the value of what I own. That's how wealth is preserved. And let's be honest, most people don't have the time to study balance sheets or macroeconomic cycles, but they understand a duplex in their town. They understand a 4-unit building bringing in $4,000 a month. Real estate isn't complicated. It's clear. That's why so many everyday millionaires got there through property, not paper. Sure, real estate has its ups and downs, so does everything, but it's one of the few investment vehicles where the bank helps you build wealth. Try walking into JP Morgan and asking for a $500,000 loan to buy Tesla stock. They'll laugh. But for a property, they'll hand you the keys and you'll still own 80% of the upside. You don't win by being nimble. You win by being positioned. And real estate positions you in the real economy where people live, sleep, and work. That's not theory, that's wealth.
ChatGPT scored at 8, DeepSeek 9, and Grok 8. Total, 25 points.
Grant, you say real estate gives you control, but let's define what that really means. Yes, you can adjust rents, repaint a unit, even refinance, if the bank lets you, but you don't control zoning laws, property taxes, interest rates, insurance premiums, or rent control legislation. Real estate might feel like control, until external forces remind you who's really in charge. You talk about debt like it's a feature. In reality, for most people, it's a trap. Leverage can magnify returns, but it magnifies mistakes faster. The 2008 housing crash didn't just burn speculators, it wiped out regular investors who thought they were safe because they had tenants. When the music stopped, they couldn't sell, couldn't refinance, and couldn't cover their payments. And no, liquidity doesn't mean panic. It means choice. It means adapting to change instead of hoping your tenants still pay rent during an economic shock. Look at 2020. Office buildings went dark, retail locations shuttered, but companies like Zoom, Amazon, and Nvidia surged. Stockholders adapted, landlords waited. You point to inflation protection. But stocks don't just survive inflation, they evolve through it. Productive businesses raise prices, cut costs, and expand. If you own equity in well-run firms, your wealth isn't just protected, it grows. You can't raise rents 15% every quarter, but a company can increase revenue and margins with scale and innovation. Real estate is not immune to underperformance. In fact, most individual landlords underperform REITs and diversified portfolios. They face long vacancy cycles, regional shocks, and rising maintenance costs. They take concentrated bets without realizing it. That's not investing, that's exposure. I'm not anti-property, I'm pro-transparency, pro-diversification, pro-mobility. When you hold stocks, you hold a piece of progress, of medicine, of infrastructure, of human advancement, not just brick and mortar, but the future.
ChatGPT scored at 9, DeepSeek 9, and Grok 9. Total, 27 points.
Michael, you talk about volatility like it's a strategy. I see it as a liability. Stocks don't ask you, they tell you. One tweet, one earnings miss, one geopolitical ripple, and suddenly your diversified portfolio drops 15%. And you're supposed to just sit there and wait? That's not control, that's surrender. You say landlords underperform rates. I say that's because most landlords think small. They buy one rental, manage it themselves, and wonder why they're stuck. But scale that model, buy 20 units, 50 units, 200 units, and the economics change. Now, you're not just collecting rent. You're leveraging teams, systems, and tax codes. That's a business. That's leverage working for you, not against you. Look at the ultra-wealthy. Real estate is everywhere in their portfolios. Not just homes, but commercial, industrial, multifamily. You think they do that for fun? They do it because it preserves wealth, produces income, and hedges against inflation. And unlike stocks, it doesn't vanish on a red day. You say stocks evolve. So does real estate. Smart investors reposition properties, shift markets, optimize for trends. During COVID, I moved into multifamily and storage. Why? Because people always need somewhere to live and somewhere to put their stuff. Stocks might pivot faster, but they also collapse faster. Real estate corrects slowly, which gives you time to think and move, not just react. You believe in mobility. I believe in foundation, in building equity that doesn't vanish with sentiment. A portfolio of stocks might give you range, but it won't give you income unless you sell. Real estate gives you monthly freedom while it appreciates. Wealth isn't about being clever, it's about being committed. I don't wake up hoping some CEO I've never met hits quarterly projections. I wake up knowing people are living in my properties and paying to stay there.
ChatGPT scored at 8, DeepSeek 8, and Grok 8. Total, 24 points.
Grant, scale sounds impressive until you realize how few can actually do it. Most investors aren't buying 50-unit buildings, they're buying duplexes with tight margins, relying on tenants who miss payments and boilers that break down. And when rates rise or the roof leaks, they don't have a team. They have a problem. You reference the ultra-wealthy. Let's talk about them. The wealthiest families don't get rich from real estate. They park money there once they've already made it elsewhere. Bezos didn't build his fortune through condos. Buffett didn't scale through multifamily units. They built empires through innovation and strategic equity, not plumbing and property management. You say stocks collapse quickly. That's the point. Transparency, price discovery. I can exit a position in seconds. Real estate, it takes months, sometimes years, to liquidate without losing equity. Illiquidity isn't a strength, it's a shackle when you need to pivot. And let's be honest, you don't really control your assets. Local politics can restrict rent increases, natural disasters can wipe out neighborhoods, insurance companies can drop you with 30 days' notice. Even in the best markets, vacancy risk and maintenance costs erode returns. The passive income dream becomes very active, very fast. You talk about foundations. Foundations crack, neighborhoods shift, property taxes rise. You're betting on physical permanence in a world that's increasingly digital and mobile. Meanwhile, companies adapt. They expand globally. They compound revenue in ways that real estate simply can't replicate. And while you sleep soundly on rent checks, I sleep soundly knowing my investments are diversified across industries, continents, and ideas, not locked behind a door I have to repair or a tenant I have to chase. Real estate might build comfort, but innovation builds wealth. History shows it. Math proves it.
ChatGPT scored at 9, DeepSeek 7, and Grok 9. Total, 25 points.
Michael, you keep saying most people can't scale real estate. You're right, most won't. But that's not a flaw in the asset, that's a mindset problem. They don't teach financial courage in school, they teach compliance. Stocks are easy, you click a button. Real estate, you've got to walk a property, talk to banks, negotiate deals. That's why it pays better, because fewer people are willing to do the hard part. You say billionaires start in tech? Sure, but ask yourself where they store that wealth once they make it. Why does Zuckerberg buy land in Hawaii? Why does Musk diversify into commercial property? Because hard assets hedge uncertainty. You don't park billions in apps. You park them in land, space, and concrete. And about liquidity. Liquidity is useful when you're panicked. But I don't invest to panic, I invest to get paid. If I own 500 doors and only 5 go vacant, I still win. You can't say the same for a red quarter in tech stocks. Diversification is only comfort when you don't have control. You mentioned property taxes, insurance, tenants. Sure, no, those are real. But that's why we underwrite deals with cushion. That's why we buy below market in the right zip codes with systems that scale. That's the difference between being a landlord and being an operator. The game changes when you treat real estate like a business, not a hobby. And let's talk about mobility. You think moving money quickly is an edge? I think it's an invitation to overreact. How many people sell at the bottom because they can? Real estate forces discipline, and discipline builds wealth, not impulse. Innovation is great. I love progress, but I don't bet my kids' future on beta versions. I bet it on buildings that house families, store goods, and generate checks while I sleep. Let the market dance. I'll be here collecting rent month after month, year after year.
ChatGPT scored at 9, DeepSeek 9, and Grok 8. Total, 26 points.
You say real estate teaches discipline, I agree, but discipline without flexibility is fragility. The world is changing faster than ever, interest rates, global supply chains, technology shifts, and while you're waiting on a permit or a contractor, capital in public markets has already moved, adapted, and grown. You take pride in being hands-on, I take pride in being scalable. Real wealth isn't just built with hammers and leases, it's built with ideas, data, and timing. Amazon scaled without warehouses at first, Uber without cars, Airbnb without hotels. That's leverage at an entirely different level. That's the power of equities, and your tenants, they pay rent until they don't. One recession, one job loss, one rent strike, and suddenly your stable asset bleeds. Meanwhile, I own companies that pivot. They adapt to consumer behavior, automate processes, expand margins. I don't need to evict anyone to grow my capital. You say liquidity leads to impulse. I say illiquidity hides risk. When prices don't move, people assume they're safe. Until the appraisal comes back 20% lower, that's not stability, that's silence before the drop. In stocks, you see the volatility. In real estate, you feel it too late. Yes, real estate can store wealth, but stocks create it, and not just for the elite. Anyone with a phone and $100 can own pieces of world-changing businesses. Try doing that with commercial property. You want checks every month? I want growth every year. I want my capital working in labs, satellites, logistics, AI in progress, not in toilets, termites, and tenant turnover. In the end, real estate might feel solid, but so did Blockbuster once. The future doesn't reward what feels safe. It rewards what scales. That's why I'll keep betting on ideas that move faster than inflation and smarter than bricks.
ChatGPT scored at 9, DeepSeek 9, and Grok 9. Total, 27 points.
Michael, you say the future is built on ideas, but ideas live in buildings. Tech companies still need offices. Labs need space. People need homes. No matter how fast innovation moves, it still lands somewhere. And someone owns that land. That someone gets paid. You talk about scalability like it's the holy grail. But what happens when the market turns? When valuations collapse and cash flow dries up? Real estate doesn't need quarterly miracles. It just needs people. And people always need space to live, work, and store. That's not theory. That's physics. You own pieces of companies. I own the roof over those companies' heads. You bet on future margins. I collect rent today. One builds hope, the other builds cash, and you say liquidity is safety. Tell that to the millions who panic sold in 2008 and 2020 or last year. Liquidity doesn't protect them. It tempts them. Real estate demands patience, and patience rewards you with appreciation, tax advantages, and leverage you won't get clicking buy on an app. Look, I'm not against innovation. I'm against dependence on hype. You say stocks move fast. I say they crash faster. Real estate takes time, sure, but that time builds equity. Equity you can borrow against, pass down, and rely on. At the end of the day, I don't want my wealth tied to headlines. I want it tied to human behavior, the kind that doesn't change. People will always need shelter, always pay for location, always value space. That's the most predictable bet there is. You want speed, I want certainty, and in a world of noise, certainty is priceless.
ChatGPT scored at 8, DeepSeek 8, and Grok 8. Total, 24 points. The final score is in. Michael Burry, 157 points. Grant Cardone, 149 points. Which means Michael Burry wins the debate. Real estate promised stability, but this time, the stock market made the stronger case. What do you think? Did the right side win? Share your thoughts in the comments. And if you found this debate compelling, consider subscribing to Debatrum. See you next round.